and the US, of course, share many commonalities. Cultural influences, social values, democratic political systems, to name a few. But the gap between the two countries has widened when it comes to the health of the consumer and the overall economy. While the US is showing signs of recovery in many areas, Canada's trade down, we'll talk about that in a minute, continues to grow. What implications does this have for Canadian investors? And where could they perhaps look for winning opportunities across this environment? Happy to say joining me today to look at the health of the consumer is portfolio manager Thomas Goldthorpe and equity research analyst Brendan Cochran. Welcome to both of you. Great to see you again in person.
Nice to meet you.
Nice meeting you.
Good to have you here. We'll invite everyone to send their questions in for Brendan and for Thomas over the next 30 minutes or so. So that should be enough time to bring up a bunch of the questions. Where we want to begin with this is that within Canada and within many of the stocks that we look at all the time, more on the financial side for you, Thomas, and more on the consumer side for you, there are lots of winners and losers. We're going to sort of talk through your ability to guide us there. Thomas, let's sort of begin with you on there is a wide landscape and there are winners and losers. Let's just sort of remind ourselves of this. How do you come to that?
Yeah, so in any sector, there's a lot of companies that have different exposures and benefit from different types of the economy. So even within the financials, and I cover the banks and the non-bank financials, there are definitely some companies that will perform better than others. And this presents good opportunity to create differentiated returns within the portfolio.
And Brandon, as well, for you're looking at the consumer, we just told a little bit of a dismal story of the consumer there, but sort of break that apart. It's not all bad, obviously.
No, it's not. And for the TSX, I'm sure as advisors will listen to us over this next half an hour, they're going to think that the situation is not good for the Canadian consumer, and I'm not going to push back too much on that.
Yeah.
But within the TSX consumer discretionary portfolio, there are actually very few companies that are 100% exposed to the Canadian consumer. We have several companies, fast-growing companies, where either most of their sales are already with the US or most of their sales growth is coming from the US. And these are situations where if you're an index investor, an ETF investor, you'd sell off the entire sector. We are the ones buying these idiosyncratic stories, getting that great opportunity on the way down because we have that medium-term thesis of what is really happening for these specific companies.
Fantastic. I ask you to sort of break down further the whole trade down discussion in a second. Give us a sense of where we are in this mortgage cycle. I mean, this has everything to do with everything. So you're looking at the banks on a day-to-day basis. Where are we going here?
Okay, so right now, we're obviously getting a big impact on people who are forced to refi their mortgages, just given how much higher the 5-year rate is versus when these loans were originally underwritten in 2019. And the issue now is the amount of mortgages getting reset is only going to increase in 25 and then increase even more in 2026. And then the rate of that impact is also increasing in 25 and 26, just given now we're resetting versus still low rates in 19, but those rates go even lower in 2020. So the size of that impact is growing. So, and the issue with that is as these mortgages get reset, consumers will still continue to pay their mortgages, but they have to make sacrifices in other parts of their lives to make those payments. So more recently, so the recent people who we've talked to the banks, and they imply that consumers that have reset have cut their discretionary spending by 10%, and that could grow to 15% next year based on current interest rates. And those customers are also have been drawing down their bank deposits as well, and some of them have even been increasing their credit card borrowing. So,
are the banks going to be okay? We're going to talk about stocks to invest here. So, I mean, although the consumer comes in just a minute, the banks themselves, there's lots of thoughts that the Bank of Canada, has levers to pull, right? If they have to, they will. Are the banks going to be okay?
Yeah, the banks are going to be fine. We're not going to have a repeat of the global financial crisis like had in the US, just given how much tighter underwriting standards are, given the degree that capital has really increased. So there's a much bigger buffer there. However, the banks should be fine, but I do think this may be a slower growth period for them.
Okay, let's go into the trade down. When we spoke last, you said that you were seeing lots of trade down. This is those that are going, tell us what it is, first of all, then we'll talk about how it's doing.
Sure. Very simply, so trade down is the best example that I think everyone can, can understand is when times are good, you take the family out for a sit-down restaurant. Maybe it's $80. $80 is probably a deal these
That's
days.
a bit of a deal these days, yeah.
But when times are not good, you take the family to a burger chain instead. So you want that night out with the family, but you want to do so within your budget. So you trade down from a sit-down restaurant to a fast casual or a fast food restaurant.
Okay.
Yeah.
And you see this across all areas of the consumer. When we spoke, and I can't remember how many months ago, but it was a few months back, you said this is really in motion. Like we thought it would happen. It's really happening. Since we spoke last, what's going on?
Yeah. So since, and I think it was back in January, where at that time it was really in motion. I think there was an element where, okay, how much longer could this really last? Like in January, if you asked me, okay, we're speaking again in May, is it going to be the same? I'd probably say
more trade downs?
I'd probably say that's very hard to imagine. It's May, it's been more.
More trade
It's been more trade down than what it was in January. So it's just that this relentless need from the Canadian consumer in particular, and things are a bit different in the US versus Canada, and we'll get into that. For the Canadian consumer, we are seeing this every day. One of the big examples out there is Dollarama, and they're very public on their conference calls talking about this. The key thing, the key indicator in the economy is when people buy their groceries, not from Loblaws trading down to No Frills, but then No Frills trading down to Dollarama. When people are buying their groceries from the dollar store, that is when the situation is quite bad. We've only seen that increase versus 5 months ago. So that trend is still really alive and well in Canada. And when we speak to the companies, when we speak to the CEOs and we ask them, what do you think if we're speaking 6 months from now, end of the year, would you be surprised if trade down was still, at the intense level that, and they're telling us, we think this is going to last for 2024 at least.
At least. Okay. Interesting. And then we'll see whether it sort of bottoms or not. Take us through to on the financial side of things. So we talk about rate cuts. Maybe it's coming soon. Maybe it's not. Maybe in Canada it's coming sooner than other places. Is a 25 basis cut going to just change the whole mortgage picture?
Yeah. So I think the thing on mortgages is
or even, the banking, more broadly.
Yeah, the banking and the economy
Yeah.
more broadly. I think the thing with the rate cuts is small incremental rate cuts probably don't make an enormous difference. So two dynamics. One, rate cuts like rate increases take time to impact the economy. So sometimes it takes actually up to 2 years to feel the full effect of it, as we saw
On the way up
on the
or
way
the way
up,
down?
and also on the way down as well. The other thing is the curve right now is very inverted. So the overnight rate's 5%, the 5-year bond, the Canada bond rate, which is what prices the mortgage off of, that's like 3.7%. So there's a very good chance that if we see the front end of the curve come down, the back end won't come down nearly as much. So the people who are refining the mortgage will still have a big rate shock, even if the front end of the curve comes down. And the thing you also have to remember is the rates were just so low, so exceptionally low in 2020, even if that 3.5 goes down to 2.5 on the 5-year, you still have a negative impact from that.
Mm-hmm.
So the thing is, we could see rate cuts and on the margin it'll be positive, but a lot of the dynamics we're talking about today will likely persist.
Okay, well, so let's get into a little bit of the inflation story for consumers. I mean, most people feel like there's tons of inflation out there. The numbers show something different.
Yeah.
Give us some of the variables within there. Why are we still feeling it so much, doing the trade downs, when actually it's strong enough for the Bank of Canada to be sitting where it is?
Yeah, so a lot of this, there is a big disconnect between how people report they are feeling versus what their finances are showing. And honestly, it's largely just the annualization effect of inflation, that now all of those price gains that happened throughout 2023, you're now seeing it on every product because all those price takes have already happened in the past. And when we speak to a lot of these retailers, a lot of these restaurant companies that were pushing price in 2023, the consensus came out towards the very end of the year, maybe November, December, that whatever price we took, we had to get it done in 2023 because the consumer is just not accepting anymore as of end of 2023. And coming into the year in 2024, we're seeing a real slowdown from the actual small business owners that we speak to on a weekly basis. They are really sensing that consumers are not accepting any more price increase. When you listen to Walmart, they just had their conference call this week. Right. They said that their actual goods, their household merchandise is in deflation now, not disinflation, no. Deflation. Their groceries are still, low single digits, which is obviously a lot better than it was before. But we're actually seeing the largest retailer, in the country, in the U.S., is in a situation of deflation. So a lot of those commodity costs have normalized. Now we're seeing, maybe I spoke too soon, we're seeing some spikes now in some materials. But a lot of the issues of Ukraine war, supply chain issues, that's pretty much over. Mm-hmm. And the consumer is really pushing back against that incremental price take, and small business owners are being extremely cautious on new price growth, which is a good sign for inflation for the rest of the year.
Really interesting. Just through the research that you do and for the purposes of those who will want mortgages, rents have actually been a different story recently. Consumer, take us through the immigration story. I don't want to get into the politics of it, but I just want to know how it's affecting ultimately stocks that you're watching, the mortgage story, the rental, the housing story, and what people are buying. I'll start with you, Thomas.
Okay, so I think the thing with immigration is obviously we've had a spike in immigration, and that's actually supported a lot of the aggregate data that is being reported. So
like growth
data, right?
Yeah.
So for example, like in fourth quarter, we had 1% real GDP growth on an annualized basis, and we had a 4% population growth on an annualized basis. So in aggregate, it has been able to provide support, I guess, to the overall economy and help, I think, the economy deal with the pressures from the higher rates. But it also has put some pressure on rental stock and has maybe exacerbated the housing shortage within the Canadian economy, though you are seeing, some signs of that abating.
Yeah, there's still a supply issue in there, no question, but it's just interesting to the extent it's affected growth. From your perspective, what do you notice? Because you might be looking at this from a slightly different angle.
Yeah, so in retail land, some inside baseball for advisors is the key metric that drives retail stocks is same-store sales, SSS, sometimes known as comparable sales. That's ticket and traffic. So how much a price goes up and how many people are buying. So in a situation where Canada's growing 4% population growth, that right there, your base case same-store sales is 4% on the traffic side. And then you get whatever pricing you can get along the way. Now, the nature of newcomers into Canada, what their financial position is upon landing in Canada, is they do skew to the low-income retailers. So as I mentioned Dollarama before, right. They publicly said that they have been a big beneficiary of trade down number one, and immigration number two. It is a great place to get your a new apartment set up. Is right. you do your initial shop from Dollarama. So they've been seeing that benefit. The other one that's been really interesting is in telecom. So you need a home and you need a cell phone.
You need a phone.
Yep. So what we're seeing is a big surge in an industry term called net adds, which is how many new subscribers these companies are adding each year. So when we got all these announcements in the past few months about immigration really slowing down, the government really changing their tune on it, I think the media ran with this idea that, okay, immigration is over. And as of April, it's over. This is not the case. And an interesting statistic that we've seen in the data is, as of right now in Canada, for the age group of 19 to 34, there are 250,000 more males than there are females in Canada.
Men versus women in terms of the immigration numbers. Why is that?
Yeah. So what happens is when you think about a family unit considering immigration to Canada, the father of the unit, the male, typically is the one who goes over and tries to set up base, find a job, find an apartment, and then the family joins 6 to 9 months later. So while the media is saying that the immigration tailwind is over, when we're speaking to our companies, they are now seeing the lagged benefit of families coming to reunite with the father.
Interesting. So what does that do for the inflation story?
Yeah, well, it means that, these dynamics that Thomas referred to on, okay, well, per capita growth doesn't look so good, but overall growth, when you account for the traffic element, the population element of the overall, that total headline number, that can probably hold in for as long as we still have this 6 to 9 month lagged benefit of families coming to Canada. When the wife joins, when the teenage daughter joins, they're going to get cell phones too.
Yeah.
They're going to want
jobs
and jobs as well.
Right.
Yeah.
Fascinating. Okay. A couple of questions coming in here. So let's do one. So do you think that US regulators cracking down on Canadian banks, there's lots of discussion on all the different levels, and particularly banks that have US operations. Do you think that's going to impact the Canadian banks looking to expand into the US? Like, what does that do for sort of the growth profile for banks who see these problems that other banks are having in the US and some of the US operations? Does it make them want to expand as much there or no?
Yeah, I think it just makes it harder, right?
It makes it hard.
So with increased regulatory pressure, it's going to be harder to get deals approved, right?
Totally.
So we already saw one major deal not get approved last year.
Yeah.
And the Canadian banks have also has to think about, okay, is this an area where I want to invest more heavily into?
Mhm.
So I think the big thing with that, with increased regulatory pressure, it just makes it harder for them to grow there. And that looks more to be a more secular thing at this point of time versus just a one-off negative headline.
So growth is going to be probably here if it's going to happen for the banks in that sense, and not the US.
Correct. Yeah.
Okay, interesting. Yeah, that's really interesting. Let's go back to sort of the differences between Canada and the US in terms of the consumer companies based here in Canada and how many of them, in fact, are exposed to the US consumer.
Yeah, sure. So maybe it's a good time just to kind of take a step back on what exactly the difference between the US consumer and Canadian consumer
Yeah,
is right now.
absolutely.
So at the low income of the US consumer base, we saw, we track credit card data. We have a lot of proprietary insights at Fidelity. And one of the things that we saw was, January was okay, February a little bit softer, and March was really concerning.
Yeah.
And at the same time, I'm sure you might have seen headlines in McDonald's CEO talking about the low-income consumer really slowing.
Totally.
What we've seen more recently is things look a little bit better. So when you try to understand why did we have that dip in March for the low-income consumer, we think in hindsight it was related to tax refunds. The cadence of tax refunds had a very unusual impact this year, where when you're looking at March, the average consumer was down like 20% year over year. And this is money that hits your direct deposit to your account, and then you go spend it. So as that's recovered, so tax refunds are now back to where they were year over year. We've seen spending in the low income start to come back as well. So we're hopeful that in the US side, what had looked, now things are not great still, but they had, for a period there, I was hearing, calls of recession. And it seems like that, for now, we seem to have avoided that case for the low-income consumer. For the middle-income consumer in the US, we are also still seeing trade-down activity, clear signs of pressure. I spoke with the CEO of a used car dealer just this week, and he told me that they are seeing extreme price sensitivity, that consumers cannot budge out of the $15,000 to $20,000 used car price range. So what that means for a family is if you thought you could get a small crossover, maybe a Honda CR-V or something like that before COVID, well, that price of that used car has gone up a lot. So now in $15,000 to $20,000, if that's all you can work with, you're going to have to go with a Honda Civic and make do with a smaller car.
There's a trade down there.
There's the trade down there as well. And finally, as I mentioned before, restaurants, middle income that's where you're going to see that restaurant trade down. Things are still really tough for the casual dining, the family dining, the sit-down restaurant. Things are still really tough.
So bring that back to sort of what the Canadian consumer sounds like they're dealing with versus the US. And then ultimately what we're looking at is sort of the Canadian stocks, the companies themselves, and how they're able to or unable to profit off this.
Yes. Yeah. So what we want is one area that does look really strong still in the US is the high income spending. So we do naturally want companies that are indexed to the higher end part of the US market. And yet there is some slowdown there as well, but there isn't that behavior shift. What we're seeing in the US is people are still buying what they traditionally buy, just at a slower frequency. Okay. Whereas in Canada, for the high income, that fourth quintile, maybe even the low end of the fifth quintile, we're seeing behavior change, trade down. So the US is people are still not really changing behavior. They're just changing frequency, which means that they're still attached to the brands that they love. So we want to take advantage of that by looking at companies in Canada that have very strong brands, that have that exposure to a resilient part of the US market, and that have really smart capital allocation strategies, growth strategies that we can be confident in a 3-year, a medium-term thesis.
Fascinating. Let's talk a little bit about capital investment, the story of how money flowing direct, we talk a lot about foreign direct investment, the idea of where we find growth in this economy right now, whether it's tied to commodities, whether it's not. Just get into the topic of productivity for us. And again, what it means ultimately for sort of the financials, how they're seeing it, what they're doing within, but also the economy they're sort of driving, but also responding to. What does productivity mean to the financials for you right now?
Yeah, so productivity is obviously a big factor. It's if you have high productivity, it allows you to run higher real GDP growth without getting the associated inflation. So what's happened, I guess, the Canadian stories over the last 20 years, you look at capital investment as a percentage of GDP, it has gone down materially. And at the same time, you've had housing investment as a percentage of GDP go up materially.
So these mortgages should kill that, no?
Yeah, it will help.
It's resets.
It'll help rebalance. So we've seen some rebalancing occur, but it's still fairly out of whack if you compare it to an economy like the United States that hasn't had the same drop off in capital investment. So at least where we sit today, we have two headwinds to productivity. So again, bringing in accelerated immigration, generally at the lower productivity end of the spectrum, weighs on productivity. And then the other thing is just less capital investment. Because for various reasons, Canada's become a more difficult place to invest.
And there's some uncertainty ultimately to sort of how regulations and so on how that's going to wash out.
Yeah, certainly.
There's
certainly there's more uncertainty around kind of the resource sector,
for sure,
how that wants to be treated, but also around tax and regulation and various other factors. So it's just a less certain place to invest. So there's been just less capital investment. So a lot of people talk about the way of immigration on productivity, but it's also been this lack of productive investment as well. And the other thing that's occurred with immigration is if you have excess labor supply, you're less willing to invest in new productive capital because you can just replace it with lower cost labor. So again, it's another consequence of high immigration is that you're less willing to invest in productive technology, or just basic like machinery and robotics and stuff like that, because you can just replace it with like lower cost labor. So net productivity does look to be lower than in the US. So innovation in the US, all that will trickle down to Canada, but given decisions made over the last 10 to 20 years linked to capital investment likely means lower productivity going forward, even if immigration does ultimately slow down from today's levels.
So I want to get into sort of picking the winners and losers, because this is what you do so well. I think we've spelled out some of the issues and headwinds to an extent. Ultimately, you've mentioned a couple of great beneficiaries within consumers. I'm going to ask you about it across the financials as well. But let's go to, you find obviously opportunities when there's this thought that it's a washout for the Canadian consumer, right? Yeah. Within that narrative, there's probably some gold.
Yeah, so there is. And one, I think something that's near and dear to everyone's heart is actually, before I give you the answer to that, so one thing that I mentioned, same store sales, right? And how important it is for tracking the performance of a company. The number one fastest growing same store sales restaurant in North America is Tim Hortons Canada. So what's going on there? So you think of a couple of things at the same time that this is happening. The typical McDonald's, Burger King, those that we think they're growing low single digits. You look at Starbucks. Starbucks is growing negative right now. What does that mean? Well, this is a brand that is exposed to the Canadian consumer, but is winning on trade down. They have a value proposition. When we look at consumer surveys, it's the number one recognized brand in terms of value in Canada. So that's a place people are going to go when things get tight. So that's one area to win. So you really have to understand the shift in consumer behavior, if you can predict that and you can pick the winners of that, that's where you're going to make those outsized returns in a time when the overall sector is not loved. Yeah.
So we're going to check in with you in X months. We'll see how that trade down story is going. Across the financial, we're not just talking about banks, we're talking about insurers, we're talking about asset managers. Again, when it looks like the Canadian economy maybe has some headwinds to go through, where else do you look in the financials?
Yeah, so I think that's right. So you try to, at least where we sit, we try to get less exposure to the Canadian consumer and more exposure to faster growing areas of both the Canadian and global economy. So whether that shows up in like in the exchanges or in payment companies or companies like the alternative asset managers, or even in some of the traditional asset managers, you can find pockets of companies that are winning, companies that are taking market share, and companies that are still executing in today's world that isn't necessarily as exposed to some of the consumer topics we've been talking about.
So there's sort of a stick handling through. So just as sort of a final thought on, again, like where to find some of the rocks that you can turn over and see this. Yeah, what do you want to share with people just as you close out?
Yes, I would say just in the past couple of weeks, I can't tell you the name of it because we haven't revealed any position sizing yet. But yeah, I think we found a great idea in the past couple of weeks that I think could be a double. There are gems in the Canadian consumer space. Again, I think it's very clear where we stand on the overall consumer trajectory and whether there's light at the end of the tunnel or not. Well, we'll check in a few more months from now and see if things are getting better. But you can't just sell off the entire sector. And while everyone else is doing that, while index funds might be doing that, this is where we find opportunities that could still be a double for our investors. We will gladly take those shares that people are selling into us, and we'll make those gains for our investors. So keep an eye out. I mean, I'm sure advisors are probably keeping an eye on our top 10 holdings that we report quite. So maybe you can get some hints from there for the advisors who want to be a little bit more in the weeds. But we are still finding really excellent ideas in the Canadian consumer space, even though we just had this little less than optimistic conversation.
Yeah, no, well, we had to lay the foundation. What would be sort of a final thought from you, Thomas?
Yeah, I think just echoing what Brandon said, right?
Yeah.
Which is there's always exciting stocks, right? Especially on the TSX. There's undercover names that people haven't done their work on, names that people are only focused on what's going to happen this quarter, not on what's going on the next year or two. And yeah, just traditional stock picking.
Right.
There's still a ton of alpha to be generated just by doing your homework, staying on top of things, and finding exciting stories and being able to develop your own independent view and not being so caught up in what's going to happen the next month or two, but instead focusing on where things will be. Right.
Thank you for sharing some of your research with us. I appreciate it. Thomas and Brandon, great to see you. Have a good long weekend ahead.
You too.